Assalamu guys, Irfan here with another video. In fact, this is going to be a series of videos on accounting. What we plan to do is first introduce the basic concepts and then in the subsequent videos use the knowledge and the skill set developed in the earlier videos to introduce more complex topics in accounting. So let's get started done. Like I said, this is going to be the first video in the series of videos. Now, what is on the agenda for this video? What are we going to learn through this first video on accounting? The first thing that we'll be looking at is the accounting equation. That is, assets is equal to liabilities plus owner's equity. Now, this is the fundamental of accounting, if you will, and that is we'll be dealing with right off the bat. That's the first thing that we'll be looking at. The next thing that we'll be looking at is the various accounting transactions that take place and what is the impact of those transactions on this equation. Now, this equation needs to hold true regardless of what transactions are going through, but we'll be looking at what impact those transactions have. And the third topic would be the four main financial statements that are used in accounting. We'll be looking at some basic for the basic statements, and then like I said, in subsequent videos we'll be building on this information. So let's first start with the accounting equation. Assets is equal to liabilities plus owner's equity. Now, what is an asset? Now, the asset is any resource or resources that is owned by a company or an organization or an entity. Okay. Now, included in this in assets, cash that the company may have at hand, or the accounts receivable, because the money that that's expected to be paid by your customers, that's also an asset. If the entity owns a piece of land or building on, that's an asset. Inventory, whether it's raw material, semi-finished goods, finished goods, that's all assets. Examples of assets: equipment. You can have machinery, you can have office equipment, you can even have office furniture as an asset. And then there's intellectual property such as patents that are also assets because they have value. Now, liability. This is what's the amount that is owed by the company or the organization or the entity. Now, the kind of things that would be included in liabilities would be loans or amounts owed on the credit lines or any other obligation that the company may have. So those are all examples of liabilities. The last thing in the equation is the owner's equity. Now, the owner's equity, what the owner owns in the company, or what is his or her interest in the company, that is the owner's equity. His skin, if you will, in the company. Now, type of ownership of the companies. You have a sole proprietorship. There's only one person is responsible. Not responsible, but one person is the owner, sole owner of the company. That's a sole proprietorship. The second kind is partnership. When you have two or more people as co-owners, as joint owners, that's a partnership. Or the third type is a corporation. Now, here the ownership is through ownership of shares or stocks in the company, and these are usually traded on the stock exchange. Now, when you have corporations, owners own corporation through their ownership of their shares. Now, when the company is doing well, the company may give part of their earnings to its owners in the form of dividends, and that is their return distributed to the shareholders or stockholders. And the retained earning, the company may decide to retain some of its earning for future use, and that would be the retained earning, and we'll be doing a statement on that later on in this video. Now, let's look at the transactions and their impact on the accounting equation. Uh, Various business activities could have an impact on positively or negatively on the assets that the company has, the liabilities, the owner's equity. So various activities would impact or alter the amount of assets that you may have, or the amount of liabilities, or the amount of money you owe, or the equity. Now, regardless of this nature, like we had said before, assets is equal to liabilities plus owner's equity. That needs to hold true regardless of the type of activity or type of transaction that's going through. So let's first look at one type of transaction. Now, we have a company called ABC Corporation. Okay. Now, a customer owed it some money, so the company was able to collect $12,000 from a customer, on an existing account receivable. Now, this is the balance sheet before before this transaction took place. Now, let's see what the impact would be when this transaction actually goes through. Now, you collected 12,000, so the cash goes up from 30,000 to 42,000. The cash has increased by 12,000. But something funny going on here. The total assets now is 912,000, and total liabilities and owner's equity is 900,000. So the equation is not matching. And the reason why the equation is not matching is because the transaction has only partially completed. There's a second half that needs to go through, and then you'll see that equation will still hold true. Now, because this 12,000 that you collected and that increased the cash from 30 to 42,000 was part of the account receivable, you need to reduce the account receivable by 12,000 also, because that 12,000 is no longer due, it's already collected, right? So instead of 45,000, now the account receivable is only 33,000. And now if you see the total assets, 900,000. If you see the total liabilities and equity, 900,000. So the equation is still holding true. Now the transaction has completed fully. And now you see, we just show you that the transaction is true. Now, excuse me. Let's see if the same company purchased inventory worth 10,000 from a supplier, and would be making payments on it. It's not just a lump sum payment, we'll be making payments. So it will be part of your accounts payable. Now, before the transaction went through, the inventory was 40,000. Now you just bought inventory worth 10,000, so the inventory goes up to 50,000. But like in the previous example, the transaction has not completed fully. It's only partially complete, because now the total assets is 910,000, whereas the total liabilities and equity is only 900,000. So there's a difference of 10,000, which is the inventory. So let's see what we need to do. What we need to do is we need to increase the account payable by 10,000, because you will be making payments on it. So it's actually an account payable. So from 75,000, the account payable is going to increase by 10,000 to 85,000. And now the total assets is 910,000, and the total liabilities plus equity is 910,000. So the transaction has completed fully, and the equation assets is equal to liabilities plus owner equity is true. Another example. The company ABC Corporation has rendered a service to a customer for $5,000, and the customer would be paying for it in the future, which is accounts receivable. Okay. Now, accounts receivable would go up by 5,000, because that's something that you'll be collecting in the future. Now, accounts receivable was 33,000. You increase that by 5,000, you make it 38,000. Now the total assets is 915, and the total liabilities and equity, owner's equity, is 910,000. Again, transaction is not fully complete yet. What you also need to do is increase the retained earning by 5,000. The 5,000 that was account receivable, also gets reflected in the retained earning. So instead of $550,000, the retained earning is going to be $555,000. And now if you see, the total assets is 915,000, and total liabilities per equity is 915,000. So the transaction has completed, equation is true, so everything's okay. Let's see another example. Now we paid $4,000 in expenses. This was the balance sheet before this transaction took place. You paid $4,000 for expenses, so the cash needs to go down by $4,000. So instead of cash being $42,000, it's now $38,000. But the total assets is $911. Total liabilities plus equity is $915. So again, not quite complete yet. Now what we do is we have to reduce the owner's equity, the retained earning, by 4,000. And instead of 555,000 is now coming down to 551,000. Okay. Now if you see the total assets, 911,000, same as the total equity and liability, 911,000. So the equation matches, transaction is complete. Now let's discuss the difference between revenue and income. Now, revenue and income, they are often confused by a lot of people and they think of it as the same thing when it's not the same thing. It's absolutely not the same thing. Revenue is the top line, if you will, whereas the income is the bottom line. Now, the revenue is the total benefit that you generated, the business generated from whatever business activity you were whatever was taking place. The total benefit that was generated is the revenue. Whereas the income is the revenue minus all the expenses you incurred to earn those benefits. That is your income. Now, revenue minus expenses, that's the income. That's the equation. Now, let's look at the financial statements. That was the third topic of this video. Now, we mentioned there were four kinds of statements. Four main financial statements that are prepared when you want to look at the financial health or the financial position of a company. These four main or core statements are the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flow. And now what we'll do is we'll go through each of them and see, try and understand what they are about and how they work. Now let's first look at the income statement. Now, income statement, it shows the revenue, expenses, and the outcomes of the operations. Okay, so basically what you're doing is when the revenue minus the expenses is positive, it represents net income. Remember how we've said earlier, income is revenue minus expenses is equal to income. Now, if revenue is more, expenses are less, then it's positive, then it represents a net income. Now, if the revenue minus expenses is negative, that means the revenue is less than the expenses. The expenses being incurred is more than the revenue, then it represents a net loss. Let's look at the income statement of for ABC company. Now, revenue was earned by selling TVs and DVDs. Now, in this 1 year period from July 1st, 2015 to June 30th, 2016, ABC sold TVs worth 42,000, DVDs worth 38,000, and some of the sales was the customers had finance, so they were paying interest to the ABC company, so the interest earned was 15,000. So the total revenue earned was 95,000. Now, what are the expenses for the same period, 1 year, from July 1st, 2015 to June 30th? The total warehouse rent was $3,000, and the cost of goods sold, the TVs and the DVDs, which you sold for 42,000 and 38,000. So a total of 80,000 actually cost you 60,000, so you were making a margin of about 15,000. So the total expenses is 63,000 as opposed to the total revenue of 95,000. So the net income is 32,000. So basically what you do is 95,000 minus 63,000 give you the 32,000 as your net income. Now that is your income statement. Now let's look at the statement of retained earnings. Now this shows what the retained earnings were at the beginning of the period, the net income for the period, negative or positive. So if it's a positive, it's net income, or if it's negative, it's net loss. And then if you gave out any dividends to the shareholders, it will show that also. And as you know, there was a retained earning at the beginning. You add the income minus the dividends, gives you the retained earnings at the end of the period. Now, graphically, retained earnings at the beginning of the period plus net income, if you have an income, net income, or negative, subtract net loss, and you'll subtract any dividend that you gave out. That would be the retained earning at the end of the period. Now let's look at the statement of retained earning for ABC Corporation. Now the earnings as of July 1st, 2015, when our fiscal year starts, was 550,000. Now the company made in that 1 year from July 1st to June 30th made a net income of 35,000. So that brings it to 585,000. And in this period, 25,000 was given out as dividends to the shareholders. So you're left with a retained earning as of June 30th of 560,000. So basically the retained earning has gone up by 10,000 because you made 35,000 as income and you gave out 25,000 as dividend. So the earnings net, the retained earnings has gone up by 10,000. Now let's look at the balance sheet, the fourth statement. That's why the third statement in this of the four basic statements. Now the balance sheet shows what is owned by the company or the entity and claims other company the entity might have against it. Okay, so the assets, liabilities, owner's equity, balance sheet will show all three. Now balance sheets are prepared as of a specific date. It's not for a period, it's as of that date. What is the situation on that moment in time? Okay. Now let's look at the balance sheet of our ABC company as of 30th of June 2016. Like I said, it will show the assets, the liabilities, and owner's equity at a particular point in time. Okay. Now it shows you what the assets were. Total assets were 915,000. Total liabilities were 235,000, and total stockholders' equity was 610,000. So total liabilities and equity was 915,000. So our equation also holds true that assets 915,000 is equal to total liabilities plus equity 915,000. So that is the balance sheet as of the 30th of June 2016. Let's look at the statement of cash flow. Now, mind you, one thing I should point out now at this point, I should have pointed out this earlier. These four statements that we are talking about, we're just giving an intro to them. We have not discussed how they are actually prepared. Those would be coming in in subsequent videos. Now, statement of cash flow. Now, this statement shows us how cash flow is generated and expended during a certain period. So it is for a period of time. It's not as of a date. It's from this date to this date. From a specific date to a specific date, what the cash flow situation was. And what we do is we divide the cash flow into three categories or three sections. There's cash flow that's coming from operating activities. Cash flow that is coming from investing activities. And cash flow that is coming from financing activities. So there are three categories of cash flows that combined together make the whole cash flow statement. Now let's look at the cash flow statement of the ABC company. Now, like I said, we're dividing them into three categories: the operating activities, investing activities. Actually, that should read investing, not inventing, and financing activities. Operating activities is the cash that you receive from sales to customers, interest that you charge, you pay, cash that you paid out as salaries, where it would be negative. The cash that you receive from customers would be positive. Rent that you paid out would be any cash going out is negative. Cash coming in would be positive. So the net cash flow from operating activities were 210,000 positive. See, 210,000 actually came in. Now, cash flow due to investing activities. We bought a building for 225,000, and we paid. And financing activities, we paid dividend to shareholders for 25,000. So there was a net increase or decrease. In this case, there was a net decrease of cash for 40,000. Now, cash as of July 1st was 2015 was 287,000. Now, cash as of 30th of June 2016 is 247,000. Now, that's because at the beginning, July 1st, 2015, net cash was 287,000. But from July 1st to June 30th, the net cash flow was a negative 40,000. So from 287,000, the cash as of 30th of June went down to 247,000. So basically, those are the four statements that we use in accounting. And like I said, we have just discussed what these statements are. We have not gone into how these statements are put together, and those will be coming in the subsequent videos. Now, if you like this video, please give it a thumbs up, and if you like to see more videos, and if you like to get updates from YouTube when new videos are uploaded in this series, please subscribe. Thank you.